How's my
Hi.
lighting?
Oh, yeah, okay, it's great. We're live, by the way. It's fast. Anyway, hi, Darian. Welcome to Winter with Grace today.
Hi, how are you?
I'm good. I was just like looking at your cat's tail. But anyway, so earlier,
Yeah, he's around. It's
yeah,
his
he's
name's
around.
Odie. He's very
um,
needy, so
oh,
apologies in
yeah.
advance.
You have I think you have a really interesting experience. You work with Mark Zuckerberg and you drop out of Berkeley. You started a company and you were about to sell it to Salesforce. And then, but in the end, you guys sold it to someone else, but like everything turned out to be fine. But like, tell us more about like the journey before Gradient, before we get into the nitty gritty of AI investing. Also, you have a
Yeah,
really interesting portfolio for like angel investing. Udemy was your first deal, all that. A Palantir later on. But anyway, okay, why don't we like I will hand the mic to you. Let's go crazy.
yeah. I mean, I think the story always starts with my family. I mean, my family came to the United States from Iran, or at least my dad's side and part of my mom's side came from Iran right around the time of the Iranian Revolution, slightly before for certain members of the family. And my father actually was in business school at Stanford, and his closest friends were Vinod Khosla, Bob Cagle, and Scott McNealy. And they were, for those who don't know, they were the founders of Sun and Benchmark. And he was really steeped in entrepreneurial culture in the Bay Area from the beginning. He always wanted to go to Stanford for business school. And the class of 1980 is very like well known. Like Steve Ballmer was class of 81, so they overlapped. There's just a number of people that are luminaries from that class. And right as he was graduating, the revolution in Iran happened, and a lot of his income, or a lot of the financial support that he had from his family, was discontinued right away. They couldn't move money out of Iran, and he had to take care of his brother, who was an American citizen. And when he was considering joining Sun as on the founding team, he couldn't because he needed money. And so he actually went to join Bain and Company, and I think that probably was a hundreds of millions of dollars, if not billions of dollars, difference, which is a shame, but sort of just the way he was sort of unlucky in that regard. But then he was lucky in other things. He was on the founding team of Zilog, which was one of the most pervasive semiconductor companies in history, which led to the creation of Xilinx, which is currently still a public business. And as I was growing up, he really exposed me to a lot of these stories and exposed me to a lot of the founding stories that he ran into. I mean, he knew Scott Cook very well from the founding of Intuit. He knew Meg Whitman from his time at Bain and Company. And all of these people ended up building amazing companies or joining the executive teams of these companies. And he sort of steeped me in the entrepreneurial culture. And he always told me, look, I'd like you to take a risk whenever you possibly can, because, I wasn't able to. And when
Mhm.
I was, joining Facebook, he said, just try to get as much equity as you can. Don't worry about getting paid a salary. Don't worry about getting paid, an hourly rate as an intern, and try to work as hard as you can. And while I wasn't an amazing engineer, I worked very hard during that time period and got to see the company really evolve from being a business that was a project, that was a school project or a college project, and evolve into being a multinational corporation that is now trillions of dollars. And during that time, there were just some incredibly smart people on that team. It was a time when you could recruit, because the only two companies that were sort of around were Google and Facebook. And if you wanted to work in a bigger company that was public, you went to Google. If you wanted to get exposed to a top quality startup, you went to Facebook. And then a number of other startups emerged. Actually, a lot of people don't know, but YouTube was actually built at Facebook, because Steve Chen was an engineer for 2 weeks at Facebook.
Mhm.
And that was sort of the emergence there, and that's how I got to know the YouTube team as well. And then when I left and went to college, I very quickly realized that college was a lot less exciting than startups, and so I very quickly dropped out to start my own business. And also, I knew Gagan Biani from Udemy at Berkeley, also before Berkeley, and that sort of led me to to invest in his business very early on and get to know Aaron. And then there were a number of misses that I had during that time period because it was such a magical period.
Mhm.
I met Aaron Levy at Box when he was with Dylan and one other person right behind uncle's house in Berkeley. And it was this like muddy pathway to like a small outhouse that had like a bunk bed set up and like these big computers in it. And they were like, yeah, we're building the next generation of storage. I walked away saying like this was silly, and I didn't invest and didn't even want to advise them after Aaron asked me to. And it was a huge mistake. But it sort of gave me the understanding that whenever something big emerges, it doesn't really look that big from the beginning. It looks like it could be just a toy, and eventually it'll emerge. It could emerge into being a multi-billion-dollar company. The same thing happened with Waze. I met Noam Varden when he was coming to the United States, and he shows me this cartoon-like application on his phone that allows for traffic redirection in Israel. And he's like, "Look, this is going to be the biggest thing ever." And I sort of was like, no, this like can't be the biggest thing ever. It's just a traffic app in Israel, which is a relatively small country. And lo and behold, it ended up being $1 billion company and everybody uses it. So I think that what I learned through this entire journey, even starting my own company, is that you really don't know what's gonna, you really have to focus on the customers and the users early on. And even things that look like a toy very early on could end up being multi-billion-dollar businesses, especially in software, because the barrier to entry is usually very low.
Mm. Oh, wow. Oh my god. I just wanna say you probably dropped, like, the name of, like, the entire Silicon Valley because and you're able to even know them exist. I feel like that's already, like, a lot of credit. Even though I know that you grew up here and then you obviously have a super successful, like, family and, like, let's go with, I wonder okay, so after so you started your company and then
Mhm.
like I guess like what was the core lessons there? I know that you have mentioned that like you have to trust the founder and like there's a lot of up and downs and then you hit a deer like this is not your founder era, but it was like some
That
story
actually
like
was
and
that
then
was right at the beginning of my founder era. Yeah,
okay.
that was a sort of external crisis. I did actually collide with a deer on 280, and it was foggy, and I almost died in that accident. But yeah, that was an interesting day and scary. But the learnings from the entrepreneurial journey are that building a business is incredibly difficult. It is one of the most difficult things to do. I actually think that it's not fun. It's very painful, and I think it gets exponentially more difficult and more complex as you become more successful, and it becomes exponentially more difficult and complex in the ways that most people don't expect. It usually ends up being significantly more complex on the people management side, on the customer side, and also a lot of external events that you don't expect to happen, whether SVB fails, or whether you run into an issue with someone you're managing, or whether you hire the wrong person, or whether you have an investor that's embroiled in a lawsuit, right? Like those are all things that I had happen. And it's very clear to me that most people think they might be cut out for it, but they're ultimately not. And I always try to assess like does the founder really know what they're signing up for? In some ways, I didn't really know what I was signing up for. I thought, this would be a fun journey to build my own business, and ultimately ended up being fun for the first couple of years, and then it was very difficult at some point. It's definitely been it's definitely a challenging journey. And now what I look for, because we scaled our business and we achieved significant revenue with large Fortune 500 customers in a very competitive space, which was Martech. I sort of learned that you have to find founders that have a bunch of different qualities. Like you need to find founders that are not only trustworthy, as you mentioned, but also ones that are very resilient, and ones that can learn things quickly, ones that can learn things that may be outside of their domain of expertise. So for example, you may not have the ability to hire a CFO right away, but you're going into a fundraise, you'll have to learn how to read a P&L, how to build a P&L. You'll have to, learn how to run a finance organization, or you may have to build an interview process. You may have to build a promotion process. These are all things that our founders are required to learn and understand very quickly. And it's unfortunately a very difficult set of practices that are not similar. And so I think a lot of founders think that they can work on their product and focus on their product as much as possible, but you're going to get pulled in all these different directions, especially because founders are different, I think, than the rest of the people that get hired. They are usually the ones that are in it for life. They're usually tied to the company in some way, whereas everyone else can like sort of leave and get another job. And that dynamic means that you really have to pick up all of the weight that doesn't get carried, or all the water that doesn't get carried by the other employees in the company.
Hmm. Okay, so I want to pivot the topic to investing because okay, for the audience who are not familiar with Gradient Ventures, why don't we start there? Let's talk about Gradient Ventures. Also, um yeah, like I'll follow up later with my 75 questions, but anyway, keep going.
Sure, sure. So Gradient is a seed Series A fund. We've invested in almost over 200 companies at this point.
Mhm.
Lambda Labs, Streamlit, Mural, Chili Piper, Secure Frame, Sona. These are all of our some of our bigger wins and bigger companies. We like to lead rounds. We make investments purely for financial return, but we have one investor in each of the funds, and that is Google, which has been an incredibly supportive limited partner in the funds. We make investments not for any strategic rationale to Google necessarily, and we make them for financial return. And we're all incentivized by carried interest in the funds on the investment team. And so our goal is to own as much as a normal VC would. We usually are hyper competitive and collaborative with a lot of the funds that are in the Valley, but we focus specifically on seed Series A AI companies. And when we say AI, we may not be focused on foundational model companies, mainly because we're doing seed, Series A, and relatively small checks. We're usually going to be investing in companies that are built on top of these foundational models or have some connection to these foundational models. There are exceptions to that. We have invested in some foundational model companies, but for the most part, we're going to be on the business applications and AI ML tooling front.
I
We also
wonder.
have a pretty extensive operating team with a lot of expertise that focuses on helping our companies find product market fit. I think if you were to ask any of our 500 plus founders, like Daniel Zarek, who I think just tweet replied to our live interview, that we probably are really good at helping companies understand where they need to be to raise their next round of funding, and we're always very honest about where they are, how far off they are from that track. I think that's one thing that a lot of VCs don't do often, is they're not honest with their founders about whether they're doing well or not. I think what we try to do is be very honest and very polite about, hey, you're this far away from being where you need to be, and how can we get you to where you need to be.
Mm, I wonder, so when you're thinking about building up the firm, since you're like a GP here, and I wonder like how do you kind of like structure your time? And I wonder also like as for investing in AI and data rich companies, since like AI is on the like basically on the major wave right now. I wonder how do you kind of um like, I guess, like, since you guys started, like, a while ago, like, in 2019, you guys started investing in AI, so you guys are early in the game for a lot of companies, and I wonder what does the strategy look like for you guys in terms of, like, picking and winning companies? And in terms of, like, sourcing, I know that for your angel investment, you may source from, like, a bunch of friends, and you obviously have, like, one of the best networks ever in the Silicon Valley, and,
Oh no,
uh
that's not true. I still have a lot of work to do, but I appreciate that. I mean, I think sourcing is not. There's no systematic way or programmatic way to do sourcing in venture. You really have to have an open mind. I mean, my time is spent probably 40% taking pitch calls, and I try to
Mhm.
go to as many pitch calls as possible. Like I don't believe that you should be this GP that relies on a junior team to source companies. Like I want the team, the entire team, to feel like anyone can lead a deal, and we have people on the team that have led deals that don't have a GP title, which is totally fine. And I also want to be one where I'm leading the deal, I'm writing as much of the memo as I possibly can, and I'm doing the work. Now that means I have to work a lot more because I'm also not only managing the existing portfolio, but I'm also looking at new companies. But I think that you have to have a flat organization and venture in order to be successful, because if you create a hierarchy, you may miss out on something. Everyone has a different perspective on what could be a big company. And typically the deals that are controversial are the ones that end up being really big. Like the deals where you may not have consensus, the deals where you may not have a unanimous vote are the ones that could end up being very big, especially at the seed and pre-seed level, because at that level, usually the quality of the founding team is what leads to an outcome, leads to a big company. And that's usually an assessment criteria of those people. I mean, there's so many companies that have pivoted from what they're originally doing. Like Slack was a video game company before it was Slack, right? So you have to have that open mind. We've had pivots in our portfolio that have, because the founders were so good. And so I think that's where we really focus.
Mm. What's your thought on like the current AI landscape? And then like where do you identify as like the biggest opportunity?
Yeah, so I think that there's a lot of hype in AI right now, but it's also seems sometimes that like a lot of the crypto founders have moved to AI, but that and that like there's a new research team that's starting a company every day. I think that the market size for AI is so gigantic that while there is a lot of hype right now, I think a lot of these companies will reach escape velocity, will become big businesses. Is that the changes in the workflows that we're seeing are going to upend every single vertical, right? From CRM to marketing automation to vertical SaaS in every sector to infrastructure tooling. It's going to change how we work. I actually think that the disruption that we've seen before have mostly been on, you know, how to make services more efficient, right? Like the mobile era or the social era, there was a lot of disruption in how people interacted online, how they bought things online instead of going to retail stores, et cetera. I actually think that in the AI wave, it's the knowledge workers that are going to have a big change. Is that, you know, investment bankers will now have memos automatically generated. And so I think AI is sort of a horizontal disruptor across all verticals, and it's going to change how we work. And there are going to be a lot of big companies and a lot of outcomes in across different sectors and different verticals. So while there is a lot of hype, I do think it's partially warranted. And so we've kept an open mind, and we've always felt like AI was a generalist thesis. As long as the company is using and leveraging AI or developing something new within AI, it could end up being a big company. And so we're keeping as much of an open mind as possible rather than having like sort of a thematic thesis and saying we're only going to do infra tooling, we're only going to do vector databases, or we're only going to do, let's say, deep tech AI, for example. So I think we've been a little bit more open minded in that regard. I hope that answers the question.
Totally. I wonder, okay, so in terms of like sourcing, picking, winning, exiting, so let me just like okay, so let's say um if we're sourcing, like should we focus on like, you know, let's say people leave the ML team from Facebook, or like should we, or like open AI, or should we focus on like, you know, the PhD at Stanford who is like developing something super new? How do we source, and like what are the benchmark you would use to like pick who is gonna win? Because like, you know, tell like when people are telling a story, they're all resilient. If they got into Facebook, OpenAI, and Stanford in general, they are resilient. But like I think it's really hard to tell like who's gonna actually win. And then there's like so many like AI wrapper companies, and then also there's like people developing the model themselves. Like, I mean, how would you kind of like spend your time on like so many options in the game right now?
Yeah, I mean it's difficult. I think I'm trying to see as many companies as I possibly can. That's always what I've done in my career, and on the investing side, because I actually don't think you can have an opinion on something. You can't restrict the TAM of companies that you're going after as an investor, because you may miss out on something very big. A good example is that, you know, we've met founders very early on, like an amazing founder, Katie Kwan, who's just started Zini. I suggest all of you check it out. It's building, and they just launched their product. She had an incredible background. She had been doing robotic automation at Stanford, then she was at Google X. And so that was one profile. We've also funded a team out of Facebook/Meta that started Last Mile AI. And these are very different profiles of people. We've also funded, you know, people that have started companies before that maybe didn't go to an Ivy League college. I don't think that there's a prototype of like, hey, the resume must look like this. it goes back to the old adage of, Harvard doesn't make people smart. Smart people happen to go to Harvard, which means smart people are everywhere. And I think that if you restrict yourself to a specific TAM, you might eliminate a very big power law. I mean, the business of venture capital is very much a power law, right? And if you restricted yourself to only the top three schools, you would miss out on certain power laws. You would have missed Apple. You would have missed,
Mm.
Cisco. You would have missed Flexport. You would have missed a lot of companies. And so I don't believe that there is a sort of checkbox of things that lead to a founder that is going to be successful. And I think that's a very different situation than someone joining a company, and actually I almost have a lot of respect for people that maybe have come from another country and have, like, against all odds, come here to build a business. If you look at a lot of the biggest companies in the world, they're all, founded by first generation or immigrant entrepreneurs. So I don't think you can restrict yourself to a specific set of people or set of founders.
I wonder, when you're thinking about if you are not at Gradient, if you're like starting your career today in investing, how would you approach it differently versus, now you're GP at a big fund and then you're like financially super set, like all that kind of stuff. So I wonder if you're starting and then you want to build an edge in your own like portfolio, how would you go about this? And like,
Yes.
like people are competing with people like yourself and that are like super successful in every way, versus like if they just start, like what's their edge?
Yeah, so I think that the key thing is trying to find a way to just help founders earlier on and more of them, right? Like I helped a number of founders, the Udemy team raise their first seed round and made introductions however I could. I helped Carbon Health raise their first round. I was the first check in case text. I think that if I wish I had spent even more time just offering free help however I could to founders. I did a good amount of it, but I should have done more. If I'd done 10x, I think I would have felt even better about like how I felt founders in the past. And so I think it's really about offering free assistance and then asking to invest regardless of the amount of money. And I do believe that the earlier you start having a positive impact on helping founders and providing real value, it's like, get on the phone at 10 p.m. to do a therapy session with a CEO that's crying because they've had a horrible day. I do that. I've done that all the time. I still do it. And get on the phone with somebody who's thinking about starting a company and is nervous about bringing on a co-founder. Like those are the kinds of free assistance. I mean, a lot of these things are interpersonal conversations, and the more honest you can be and the more that you can help direct people and help them make these difficult decisions, I think that that'll pay dividends because people talk. They say, oh, this person helped me a lot think through this issue. And we all have things that we're good at advising on. Like I think that every person has something they can contribute in the startup community. So that's what I would have done more of. I felt like I did a good amount, but I wish I had done a lot more. And there's a good amount of time in the day. And if you are lending a helping hand to founders, that'll pay dividends because those founders will say, hey, this person really helped me. And before you know it, you'll end up in a community where people want to take your money. And
Mm.
even though it is competitive, a lot of rounds are many investors now. Back when I started, it usually was one fund that led the round and maybe one or two angels. Now you see maybe 50 people, and there's so many different instruments like roll-up vehicles that allow companies to do this, very easily.
Mm. I wonder if you don't have like, so like I guess like when you are more successful, of course you can have more free time to advise the founders, and then also the founder want you to advise them. But if you're like a younger person and then like you don't have enough um bandwidth to like go after, like 65 companies, because and then one of them turn out to be Udemy or like some like bigger companies, and like, what if you're helping with the 5 startup that all died? And also, like, what do you even help them with when you're like younger? There's like
Well,
people throw in the.
five startups that all died. I mean, there are many failures that I've advised founders or people that were at those companies that failed that went on to be very successful. You just never know. I mean, that is also a really big learning about Silicon Valley is that company one may not work, company two may not work, company three, four, five may not work, but founders that stick with it sometimes they land on something and ends up being incredibly successful. And when you do it your second, third, or fourth time, you're more likely to succeed because you'll avoid the mistakes that you made in the first time, if that
Do
makes
you
sense.
have a yeah,
Sorry, go
yeah.
ahead. Go ahead.
No, you go first.
I was also saying that how do you allocate your time? I mean, I think that allocation of time to helping other founders is like that's something that if you're interested in it, you'll find the time. And there are so many meetups in San Francisco, New York, London, etc. There are so many people that are starting new companies, and it's amazing how most founders they want to pitch their company and they want other people to listen and they want feedback. That's normal. So if you just start by listening and in interacting with other founders that are out there, I think it'll pay large dividends in the long run.
Mm. Okay, so I have a couple questions around like the investing line. So like when you're identifying the job of being an investor, there is of picking, winning, and talking to founder, like helping founder part. But there's also like you have to kind of build a model for yourself to financially return the fund. So I wonder what does that thinking process look like, and in terms of like investing in early stage, do you model out like do you build like a model on like basically portfolio construction and like how to like what's your expectation for each company since they're very early and then they probably the business model is going to change, everything is going to change, and how do you really like pick the company in general?
hmm Yeah, so at the pre-seed and seed stage, it's really going to come down to the quality of the team. Like, can they execute on the vision? Do they meet the sort of qualities that I mentioned earlier on in the conversation? But then also, is there an ability for us to own enough of the company where we can really realize a strong return? And we typically look to own somewhere between 10 and 20% of a business at the pre-seed and seed stage. When we look at the model, I mean, in the case of software, it's relatively easy to evaluate whether it could be a big business based on your estimation of what the ACV could be and what the need in the market is. But for new frontier tech investments, you really have to have a leap of faith. And like at the end of the day, I've had a few VCs tell me that valuation that along my career, valuation at the seed and pre-seed stage is kind of made up because we just don't know how to evaluate it. But what we do know is that if the terminal value of the company is, let's say, 5 billion, what do we need to own in order to repay the fund, assuming dilution? And you can sort of back into that outcome. Now, when we think about these frontier tech companies that are not clearly software defined, that don't have clear ACVs, you really have to build a portfolio of what we believe is somewhere around 30 to 40 companies per fund and own somewhere between 10 and 20% of those companies. If you do that really, really well, your chances of hitting a power law company, assuming you're evaluating founders for quality, you're evaluating markets for how big they are, you have a very good chance of returning the fund and doing even better than just returning the fund. And we've done that. We've executed on sort of that process over the last 3 funds and done very well, I think. And so as a result of that, I think we're going to continue to think about things in that way, is that how do we own 10 to 20%, evaluate founders for their trustworthiness, their resilience, their ability to be autodidacts. And then on top of that, how do we assess the TAM to see, is there really a company that could be 5 billion plus that it was within this market? Like, could the market support that big of a company?
I wonder when it comes to winning the deal, I don't think Gradient or you have any problem winning the deal,
We
but
did in the beginning. I will say, like when I first started, it was a fund that we had just started building, and it was tough to win. And what we did do, and sorry to interrupt there, but what we did do is we started to partner with a lot of top quality VCs, such that our brand association would improve. So we immediately started to say, hey, like, can we join around that Sequoia is leading? And we did that. Can we join around that Benchmark is leading? And that allowed us to gain some credibility in the market. But then it comes down to the grassroots work of getting founders to say, hey, that team at Gradient helped me find product market fit. The more people we can get to say that, the more likely we are to now be able to win with a stronger reputation in the market. I'd
Mhm.
say we've done well. There's a lot more work to do, though.
How I guess like how big's your team, and then like how do you allocate the talents on your team, and how closely do you guys work with Google?
We
if
have
at all?
25 people on the team,
Mhm.
and we have a good mixture of operators, people that help with sales support. For example, we have someone named Kyle Duffy who used to run a sales organization within a startup called Revenate. He knows exactly how to hire your first sales rep. He helps train
Mhm.
that sales rep, helps compensate that sales rep. We've got Katie Engel who helps you recruit executives and make sure that the recruiters that are in Silicon Valley prioritize you as a company over other companies, and we sort of play that game to make sure you're recruiting you have the best recruiters helping you. And we have also got people like Jackie on our team that are helping with getting you an announcement in TechCrunch. We have a wide
Mhm.
array of investors as well, and that are working on new deals, portfolio support, interpersonal dynamics within the company. So we sort of built out this strong practice within the organization that can help you find product market fit, which is what we really want to be able to do. I think that's the mixture of the team that really leads to success. Like the small teams in seed and pre-seed are really effective, and if you do a good job of like providing this consistency of services, because most of these companies are technical founders that need to get into go to market, and then also need to hire, also need to do some PR, also need to do some business development. Those are like pretty common things that are within the that we've built practices for within the organization.
Yeah, I want to say hi to the audience. Hi, Elike. I can't pronounce people's name. Anyway, so I wonder when you are thinking about like the investing side of things, what does the process look like from can you walk us through from like any time that you meet the most like recent investment and then to you make a decision on investing in them to winning the deal to, potentially thinking about the outcome slash exiting and all that.
Yeah, it's so deal making in my mind is messy, and it's messy because there are so many investors, especially for the best deals. When there are a lot of investors, it's hard for a founder to determine who they should go with. There's a lot of different issues and dynamics. Sometimes if it's competitive, the valuation starts to go up, and then you have to constantly reevaluate what your risk reward will be in the deal. I think that for the best companies, the deal making is messy, stressful, and typically if it's a top quality deal and you can identify that it's a top quality deal, you got to move. You got to move within,
Mhm.
72 hours. I think some of our best investments have been that fast. And it's really, I think that's an advantage we have, is that we have a very quick process, and we try to make a decision quickly, not to waste the founder's time. When I was a founder, I really despised the, hey, send me your deck, don't hear in 2 weeks. I try not to do that as much as possible and try to get to an answer quickly, especially at the pre-seed and even sometimes at the seed stage. And you really do know, once you've seen thousands of companies, which I think at this point I probably have, and many people on our team, like I think Zach's probably seen just as many companies too, is that you want to be able to assess quickly that, hey, this is something I want to work on, because you have to not only assess whether it's a good investment, but also whether you want to work on it for a decade, because it'll be at least a decade if it ends up being successful.
Mhm.
So I think that combination is really what we look for. But in most cases, our process, we try to move very quickly. I'd say the average amount of time is about a week, but we meet every Monday. Sometimes we do, we do meetings during the week. Sometimes we're on GChat with the entire investment team, and we try to get everyone's opinions as fast as possible. If we were doing many Series A's and Series B's and C's, we would obviously want to have a lot more assessment time, because we're looking through a large data room, and we're also probably deploying a much larger amount of capital and doing fewer investments out of our fund. But given the strategy that we've employed over the past 5, 6 years, I think that we have to move quickly. Otherwise, other people will beat us to the punch. Like there are many, many seed funds out there that are great. And so why pick us? Yes, we can talk about our value add, but also the efficiency of the process is really important.
Mm. I wonder, can you like, is there any specific company that maybe you can talk about? Like let's say, like walk us through how you meet them and then like what you feel like were um interesting about that company. We
Yeah, I
could
mean,
tell
a
something
company.
for
I'll
yeah.
tell you a story about a company called Benapass, which is run by Jacqueline Chen, who she's an amazing CEO. She just raised a new round, and she's in the benefits management space, reinventing HSA, FSA. And I remember we met her. let's see, March 8th, 2020, which was right as the pandemic was locking down. And
Mhm.
we made a decision internally as a fund that we were going to invest into we were going to invest through the pandemic ambiguity. Is that like,
Mm.
hey, we think the pandemic will ultimately subside. We think that software companies will be resilient. And so let's continue to invest. And YC Demo Day had just happened. All these YC companies were concerned, are we going to get funded? And so we met the company, we back channeled the founders because two of them had worked at Google before. We back channeled Jacqueline as well. We really realized that we wanted to invest in something that could improve upon what Health Equity had done. And we were able to assess the market, with all the disruption around us, that like the city is locking down, or not, or the country, the world is locking down, chaos is occurring. We were able to be sort of long-term thinkers through that process. And I think within a week, we delivered a term sheet to lead the round. And they, thankfully went with us. And since then, the company's done quite well. And so I think that our process there was quite fast in spite of all the disruption around us. And it's really important, I think, in venture, because we invest upon a 10-year horizon, that you have to be able to set aside the externalities that are temporary and say, what is the world going to look like once this is a mature business, and have confidence that you're going to get to that end state. And I think we were right. That's one of many that we did during the pandemic, or at the beginning of the pandemic. Another one is, Chili Piper, for example, which still, is doing quite well. So I think that the long-term focus and sort of ignoring the temporary externalities, which is difficult for humans to do because humans are typically have a fight or flight sense around a crisis. And the obvious answer is don't invest when the pandemic hits, right? And we made a decision to actually invest and continue to deploy during the pandemic, which I think was a really smart decision.
Mhm. I guess when you were talking about these two companies, what does the investing landscape look like in their own sector, and why did you pick them versus like their five competitors?
Yeah, it really came down to founder quality. Like the founders of Benapass were stellar, like two incredible engineers, an incredible leader who had been in investment banking or private equity and wanted to build a company. I think that it was really down to the founder quality more than anything else. It's interesting that in a lot of markets, especially in software, they're not winner take all markets. And so, as long as you bet on high quality founders, there's a good shot, even if you're the number two, that as a venture investor, you'll make money. And so, look at Slack, Discord, it's only on the consumer side that you have these incredible winner take all, like strong companies. It's why consumer is so difficult, it's so difficult to invest in consumer, because a lot of these markets are winner take all. So I think it really came down to founder quality. Like Nicholas and Alina, they were very good at executing. They were very focused on the numbers and growing the business. They've still been able to build a relatively big business in spite of there being Calendly out there that is a bigger business, right? And that's okay, because it's not a winner take all market. And that's kind of the learning that we've had in enterprise software, at least I've had in enterprise software.
I wonder when you are thinking about, let's say, I'm sure you're coming across a lot of opportunities in, let's say, um, basically an AI company in a specific sector, like the ChatGPT function, but for X, for like the financial industry or for healthcare or for something. So I wonder when you're examining these companies, when it comes down to the founder, let's say the founder have worked in the industry and they are technical, and what would be the questions that you ask to evaluate if they're a good investment? And also, like, what are some, I guess, like, how do you articulate this to your entire team or like other investors to kind of like convince them? Like, basically, what does the internal VC sales process look like for you as an investor?
Yeah, so at first we're assessing, the feasibility of the technology. Do we believe that the technology is feasible? That's a relatively quick assessment because a lot of us on the team are technical, and a lot, like for example, we have, and not only are all of us almost all of us former engineers or have some computer science background. We also have, Vig, for example, which is like a PhD in AI. We have people on the team that really do understand like whether technology is feasible. So we can quickly assess that. Then we've looked at founder quality. On the enterprise software side, which is where we mostly invest, the questions that I'm usually asking are the founders are, how do you sell it? How do you get leads? Is there any inbound? What's the quality of that inbound? I'm asking these questions because in most cases, technical founders that have no business interest are difficult to fund or difficult to get over the line, because you ultimately have to monetize the solution. And so I want to see at the founding team level some thinking or curiosity at the very minimum at the pre-seed stage, and some execution at the seed stage, some sense of like, how are you gaining inbound? How are you building a marketing engine? How are you thinking about sales? And the answers there that I'm really looking for are, for example, Arrows, which is a company that we've seeded that's doing quite well. Daniel Zarek, who's been commenting on this and making jokes because he usually likes to make fun of me. But anyway, he's an awesome founder. He has been doing an incredible job of producing content because he knows that that's what leads to lead generation. He has case studies on his website. The Sona team, which is one of my favorite companies, the Syrup team, which is another one of our companies, it's an AI company. They do an incredible job of cultivating customer stories and case studies. And we're asking a lot of questions in the early days, like, do these founders actually care about that? And how would they execute on it? Then after that, how would they sell it? Like, are they going to be able to sell it? Because the founder is going to be the best salesperson for an enterprise software product. And are they going to do a good job of selling it? Are they going to go and walk the halls of these customers? Are they going to go meet these customers face to face? Like, those are all the questions I'm asking in a pitch call. And that to me is really the gap that needs to be bridged between technical founding team with really strong, technical chops to a business that can have a sustainable future. And so that's really, I think, where we're assessing or spending a lot of our time assessing.
I think that's great. Like, because I feel like I feel like it comes down to the pattern of like, can people be technical as well as like, can they sell in general? And I wonder, like, what would be the benchmark that you're using to judge if they are gonna be good at selling? Obviously, are they able to convince their investor, aka you? That's like a good indicator. But I think that's also kind of like personal, right? Like, so some people are good at selling technical investors, and some people are good at selling non-technical investors, and people have different storytelling advantages or whatever. But I wonder, would you judge them based on the traction, aka like how much revenue they have generated based on what they have, or like how, like, what would be some actually like interesting benchmark to look at? And yeah, like, how basically how do you evaluate the
Yeah,
people who
I'd say that for me, the number one indicator, if it's possible, is inbound. And are there
yeah.
people that are raising their hand and saying, I want this product? Are there
Mm,
people, and who are those people? They don't have to be paying yet at the pre-seed and seed stage, but they have to be raising their hand. And also, it could be not necessarily directly to that company's product. It could be just in general in the market. Are there people talking about, hey, I want this product? And how have the founders cultivated that audience? For example, we have one company where it's purely just open source driven demand right now. We have a few of those actually, and you can tell very early on whether there's need in the market from customers that are raising their hand. Like we saw in physical, which Vlad commented, he's an awesome founder in the security ops space. We saw very early on that, hey, people were raising their hand and saying, I want this product. They were starring it on GitHub. They were, asking them questions about the product. They were implementing it themselves. Same goes for Mage. Tommy is an incredible community builder for developers. And he from the very early stages was getting developers to say, hey, I'd rather use Mage than any other data integration solution. So I think that it is really, there are those indicators early on at the pre-seed and seed stage where you can see whether people are asking for the product and asking for the solution, and how are the founders responding to that? Are they engaging? Are they engaging in the right way? Are they cultivating that community and building it? So, for me, that the indicators are really inbound demand at the pre-seed and seed stage, if possible, more so than revenue. I mean, it's revenue is usually, difficult to assess at these early stages. And I think drawing a line at $1 million in ARR of what it's going to be, that's hard to do. You can assess quality of that revenue, quality of that customer base much more from, are people raising their hand? Are they engaging with the product? And those are things you can glean, but also the founder response and how they are interacting with that customer community.
I guess like when you are doing the diligence on like if there is inbound, like because people will tell you there is inbound, but like I wonder how would you kind of access it? Would you just go on like let's say GitHub and then like stalk like who is there or like how does the process look like for you? Or like would you go on Reddit or like would you go on developer communities to just like or would you like I don't know like just like being undercover at some conference or whatever, like how do you kind of talk to the end customer and what like I guess like also like how big of a ticket they have to sell like because I feel like a lot of them will describe like their so like I mean as a smaller check writer tiny angel investor I feel like the founder would dodge the question to okay so you don't know about the industry like our industry is like oh like we are deeply connected with like internal blah 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 so basically they're telling you they're able to sell to their let's say developer community or something like but how do you do the diligence to kind of like vet if that's true and like if people never heard of them like are they just identify as like bad or like how I guess like how would you go about the diligence process also do you go proactively go after things that you find on like let's say GitHub or something like or do you go for more of like okay so if we have heard of this company that means like they at least have able to sell to some people in our team and that's a better indicator that I go after something.
So all of the above on the data analysis side, like you can even sort GitHub by the most active repos in the past week, and there's so many different sources and different systems that will let you do that. So we do go outbound. A lot of inbound is people looking for funding. Sometimes are not the best opportunities, and
Mhm,
sometimes the companies that don't need funding are good opportunities. Um, and so we do go outbound. We do look at stars, we do look at comments, but I think it really comes down to sitting in conversation with the founder and saying, tell me
mhm,
about your most addicted customer,
mhm,
tell me about your next most addicted customer, tell me what the customers are saying, and then validating that in a back channel way. I think you can quickly text people at different companies and say, have you heard of this solution, have you used this solution? But asking those addicted customers and asking the founder to tell you the story of what the customers are doing, you glean a lot from that. And I think that is where I spend a lot of my time, is that tell me about what your customers are doing with the product, how you intend to improve their engagement, how you intend to solve some of the problems that they've uncovered, because then you can sort of assess, is there product market fit? Like if there are addicted customers, they're all using it for the same thing, they're all saying it for the same use case, and the use case is consistent, like you can very quickly assess, oh, does this have product fit? Maybe it doesn't have market fit yet because they haven't scaled the marketing org or the sales org, but you can very quickly understand, like, is this product fit within the customers that they're going after. So I think it's really just asking those pointed questions in the conversation with the founders and saying, tell me about which customers are addicted, what are they doing with the product, and how consistent is that? Then separately, what I also look for is, what was the implementation like? How hard was the implementation? Are there 5 engineers on your team required to implement the product? Or is it one click and they swipe their card and they suddenly, use the product? So, and they're going to be different, companies within that spectrum of like where they need some level of hand holding for the implementation. So, it is a nuanced assessment strategy. There is no programmatic way, as I've said
mhm.
before, but you can sort of assess based on how the founder responds.
Let's say if they're saying, okay, we're selling to cybersecurity companies in blah 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 scale, and then absolutely no cybersecurity companies in your existing network, how do you go ahead and like break through to be like talking to the right people to figure out if this is like legit?
Yeah, that's difficult. I think that the you have to ask for customer references in that case, and you have to be able to talk to the customers. When you get on the phone with a customer reference that's been given to you, which we do all the time, and sometimes it's not possible, sometimes it's too early, and if that's an area where you don't have any back channel connections, it may not be the best ecosystem to invest in. Is that you want to be able to do some back channel assessment, but when you ask the customers the question, ask the founders the question, you can tell what's a canned response and what's not. You really can, especially if you've been through a lot of these conversations, which is why it's important to see as many companies as possible, diligence as many companies as possible in order to get really, good at investing.
What's your thought on exiting strategy? So since you sold your own company and also like on the counter side, you are, I assume, hella rich. So like I don't think like you have the
I
urge
wouldn't say
level.
that. No, no, and
Like
that's not the point of Silicon Valley. I think the point of Silicon Valley is building, and that's what gets me excited. It's definitely not the money. It's the for me. So
I guess I'm just curious, how do you think about the exit strategy? Like would you, if you're running so like I mean you are running a fund, so like let's talk about like, when you're thinking about like how these company will have an exit or will have an exit, how do you kind of predict that from a very early on?
yeah, first off, Zach and I basically run the fund at this point, and he's been an incredible partner as we've built Gradient, and we try to be as flat as possible. So I definitely we talk a lot about exit strategy, whether we should exit. We've exited deals, we've sold Streamlit, we've exited our positions in certain companies at the right time. It's difficult because there are some companies that end up being incredibly high flyers at large valuations that end up not working out, and there are so many unicorns right now that won't work out. Exit strategy is not something that I think anyone should really be fixated on within venture or startups. You should only start to think about your exit strategy if you've run out of roadmap, or you can't raise more money. And that's I think where I'd really think. And then the third one is you get a preemptive offer that you aren't expecting, and you have to consider it. But if you're like actively pursuing an exit, and you still have roadmap, you still have the ability to raise money, that's a point in which maybe you as the founder are tired and should bring in a CEO to run the company, or maybe you're not happy with some kind of scenario within your business, because I think selling is only something you should do in that case. And as far as my company, I mean, we had the third thing. We were preempted with a term sheet to sell the business, and so that was a different scenario. But I think those are really the key things that I would say. But don't get too fixated on that. Like, you should only become a founder if you want to build something, if you really are obsessed with the problem, and you shouldn't really be thinking about the exit at any point. It's unless you run out of runway, or you're running out of runway and can't raise money, or you can't think of a new product feature or a new product roadmap to add to the business, because companies are bought, they're not sold.
Oh my God, I wanna touch up on what you just said about like companies are bought, not sold. How are you like, so how would you position yourself to be a valuable company? And I know it sounds like a really big question, but I'm just trying to say I feel like um I think a lot of it is building a great product, building a great team, of course, but like there's also some sort of like sales element to it. Like, I feel like I constantly seeing like the biggest player is the people with the biggest distribution, aka are they good at sales?
Mhm.
And I wonder, like, I guess like when you were looking at these earlier stage company, um, since you have grown a company into at a position that you guys already sold, and like, can you teach us more things? Let's say three golden nuggets about like selling a company or like being
Oh,
able to like
it's
run a
very
company.
difficult. It's very
Okay.
difficult, and there's so much broken M&A in Silicon Valley. I've even seen it in our portfolio where a company issues a term sheet to buy the business and it doesn't work out. It's very difficult. I think that M&A is one of the more difficult markets, one of the most difficult things to do. It's just very fragile because the motivations on the buyer side are usually very different than the seller side, and corporations usually don't understand what it means when you issue a term sheet to buy a company, because as soon as you get a term sheet to be sold, you as the founder immediately lose power. All of your employees start to listen to the buyer in that period between the term sheet and the definitive. I don't think that there's a good strategy on how to sell a business. I think it's very, very, very difficult to do. It is, talk about raising money being difficult. Selling a company is probably 10 to 50 times more difficult. And I unfortunately don't have great advice on this, because most of the time the M&A that you see happen is not that a company says I'm for sale. It's strategic buyer says we need this asset, we're going to put out a term sheet to buy it, which is why as a founder, you should always be optimizing for being an independent company with independent growth, with an independent strategy. As soon as you start optimizing for an M&A outcome, I think that's when things start to get really difficult.
Mm. That's really interesting. But I've seen a lot of, let's say, consumer-led company, like maybe this is like irrelevant to the AI data sector, but I've seen consumer company have been like very great, like after they've been bought by somewhere. But I wonder, like, why would a bigger company like typically buy these smaller company besides like the acquihire factor? Or like are they buying distribution? Are they buying a new technology, or are they buying for cloud? Or like what is the thinking framework
It
there?
really depends. I mean, I think it could be for talent, it could be for strategic fit, it could be for even a PR reason. There could be a
Mm,
lot of reasons that a company wants to buy another company. I think this is one of those things that you just cannot microwave. You can't microwave a sale. I think financings, there's so many capital providers, they're incentivized to deploy capital in the venture side or the angel community or private equity. But and they're in a different business. When it's a strategic buyer, it's just very difficult. It's very
mm,
difficult to predict. And so I think as a founder, you only can control your own destiny. You can't really control what the buyer will do. So
mm,
I think that's the best answer I can provide. I wish I could provide some expertise here, but there's really no one that can advise on this because it's just so rare. And I think that if
mm,
you do get M&A interest, be wary of corp dev teams just trying to steal info from you or trying to get info from you. I mean, there's a good blocking and tackling. There's like, there are some corp dev teams that are incredibly helpful, incredibly valuable. There are some that are, destructive. And you have to really be aware of that. I think you have to share and try to partner with as much as you possibly can. You have to share, be transparent about your business, but you should be wary about like spending too much time on M&A. You should, keep up those relationships, but not assume that you're going to get a term sheet if you've had 2 or 3 meetings. Usually these take long amounts of time unless they are for a very strategic reason and the buyer really needs it right now. And we've had cases where that's happened. But for the most part, M&A falls apart or it ends up being not a great deal, or it ends up being something that is just like very, very difficult to get to an outcome for. So I think it's, focus on your own destiny, build a great business. And from there, I think the outcome will come.
I want to be mindful of the time, but I want to ask one real question before we move to 1 minute fire round.
Sure.
Okay. So I wonder, so since like you guys are focusing on AI, and then like I think there is two of the big kind of like category of like major broader level thing question people have. One is like open source versus non-open source, and like the other big question is this like a game for the incumbents to win, since like they have the major, you know, they have data, they have capital, they have the top talent. And I wonder, yeah, what's your thought on the opportunity side?
And
And
this is
yeah,
the foundational model side specifically.
no, just like overall, like one is, yeah, a
Overall, okay.
foundational model and like overall opportunities in AI. And then the first question was open source versus non-open source will win.
Yeah, I mean, I think that open source versus non-open source, I think it remains to be seen. I think we just don't know. I really admire some of the things that Meta is doing on the open source AI side. I think that team is executing incredibly well, and it's just amazing to see that they have such a large amount of compute. I'm very
Mhm.
excited to see what happens with Llama 3, but I'm also excited by Gemini and excited by what OpenAI is doing. I think that we don't know the answer to that question yet. I
Mhm.
do believe that there will be a whole host of applications that will want to be self-hosted and open source based, and there will be some applications that will be API based. Very similar to how cloud services have evolved over the past 10 years. Is that, if you think back to 2004, 2005, I mean, all these companies had co-locations in their own servers. Now nobody
Mhm.
does that. And
Mhm.
so we've seen, and that's a combination of open source and closed source services in the cloud that people are using. I think that's going to happen for AI services as well. you're going to have some closed source solutions that will be really great at certain applications that are provided by Google or Microsoft AI or OpenAI. And then you're going to have hosted open source models that are provided by third party vendors that are going to be really, great for applications that may be in the regulated space. Like people, I think, will want open source solutions in Palantir AIP, but they'll also want, to use Gemini for other things that maybe aren't, regulated or aren't closed source and highly secure data. So that's sort of how I feel about open source versus closed source. I think there's going to be activity in both, and it won't be one that wins clearly, but there will be one that necessarily is more has more usage. So that's sort of my view on the open source versus closed source. And the second question was on what sectors in AI do I think are going to be big. I think that's something that we look at every day. And as I said earlier in the conversation, so many different verticals are going to be disrupted by the innovations in AI. We're going to have new forms of CRM, new forms of marketing automation. We're going to have new forms of contract lifecycle management. We're going to have new forms of how we automate, investment banking assessment or diligence documents for real estate transactions. It's really kind of endless. And so I think the question is like, how do we find the best founders in each of those ecosystems?
Amazing. Okay, we have a 1 minute fire round for you. Uh, number
Okay.
one, number one, what's your favorite book? I know
Oh,
you were
what's
gonna
my
say
favorite book?
Sapien. It's not Sapien, right? I'm just kidding. I heard you say Sapien in other interviews, so we want some other book.
Well, I actually have started reading this book called The Wizard of the Kremlin, which I think is pretty awesome. And it's actually a novel that is about this, person that sort of evolved
Mhm.
Putin's thinking over time. But it's based on some true stories. I do think that we are in a pretty incredible juncture right now in the world where there's a battle between Eastern and Western values, and I'm trying to read up on it as much as possible, and because I'm interested in it, but also because I'm afraid for what the future could mean. I mean, the United States and America is one of the best places in the world. It's where my family was able to succeed and thrive and have freedom. And I'm just very afraid of some of the things that are happening in the world. So I'm spending a lot of time reading books in that sector.
Um, who made the biggest impact in your career?
Who made the biggest impact in my career? But definitely my father, without a doubt.
Who would you invite to your dinner party?
Who would I invite to a dinner party? Oh, that's a good question. Um, I don't know. Like, can I say multiple people?
It's your party.
I'd really like to learn a lot more uh, from Ray Dalio if I can. Like, I think his books are quite interesting. How he thinks about the world, how he thinks about markets and debt. Like, I'd love to have dinner with him and hear what he has to say. I think that especially right now, we're in sort of an interesting period in the world, and that's what I'd love to, like, have the ability to ask him questions about the broader ecosystem in the world.
Where can we find you outside of work?
Oh, Twitter or X. I guess it's X now. Yeah.
Okay, give us your
Well,
X handle. Give us your X handle if they come from LinkedIn.
it's Darian 314.
Awesome. Uh, that's pie. I mean, yeah. Anyway, okay. Thank you so much, Darian, for coming on the show today.
Awesome. Thank you, Grace.